everyone, welcome back to my YouTube channel. Today's video will be all about short-term decision making, how to tackle a short-term decision making question, where to start when you get a question like it, and then we're also going to do one of the old ITC questions, and then we're just going to look at one of the questions there which focused on short-term decision making. So I added a link in the description below where to get the question paper, a link to the website, and then before you start actually watching the video, just make sure that you did the question so that you can also be as ready as possible. Right, when we jump into the theory of short-term decision making, so firstly, short-term decision making forms part of the bigger decision making process. So I don't see it as a separate thing. I see decision making as one topic, and decision making is all about making a decision for someone, or after a decision is made, what's the impact of that, right? So decision making can be split into long-term and short-term. Short-term, which we will be covering today, but it's very important to note that these two questions can go hand in hand. One sentence in a scenario can change the question so much that it can go to long term or either short term. So it's very important that you see it as one concept. The concept still stays the same. There's only certain differences between the two based on what becomes relevant, what is not relevant anymore, and so forth. Right. So there's two basic principles that underlie any decision, and it's relevant costing, whether something is relevant or not, and opportunity costs. Right, so those are the two main principles that you need to know for short-term decision making or any decision making process. Relevant costing are all those costs that will be affected by the decision. Right, so if it's affected by the decision, if it changes because of the decision, then it is a relevant cost. Now, mostly all of your variable costs will be relevant, because if you didn't have a decision, you wouldn't be making the unit and you wouldn't have the variable cost to go with that unit. Where it becomes a bit tricky is with fixed costs, because some fixed costs you can change or will be affected by the decision and some won't. Right, so in this relevant costing, it's very important for you to go into each and every cost in the scenario and ask yourself, is this relevant? Was it affected by the decision? Will it change because of the decision? And is it then a relevant cost that I need to include? Just note that there's a video separately on this, on relevant costing, so you can just click on the link and then you can watch the relevant costing video to understand that principle a bit better. Then opportunity costs. Those are everything that you had to forfeit because of the decision. So it's anything that you have to give up. Now, it can either be giving up sales, it can be forfeiting some kind of discount or lower cost. If you know that if you didn't have this decision, you wouldn't have to increase your capacity load in the next year, that's an opportunity that you're giving up. Anything that you're forfeiting. Now, remember, a forfeit cost won't necessarily be triggered separately in a question. It's not as if it's going to say, this is the opportunity cost. You have to read in and really identify an opportunity cost. So it's important for me that you note where you are forfeiting something, and then to force yourself to go back to the question and to your answer and go put that opportunity cost in. Right, so those are the two main principles. There will be videos on each principle separately, so you can just go click on the link and then you can see those videos. Then the next important part of decision making is, what is your goal? What are you trying to achieve with this decision? Now remember, there's three types of decisions. For me, these are the three main types. You can get more, it can expand. Any question can be different to the previous one. The question is, are you making a decision, and what type of decision are you making? It can be calculate a price. Remember, that's a decision. Decide on what price you are setting this on. Or it can be evaluate. Will you go on with this decision? Yes or no? Is it profitable? Will it have a positive impact on your financial statements? And then lastly, calculate the units, the number of units that you should sell for this decision to be able to be profitable. So it's all three decision-making goals, right? So for me, any question, when I read the question, I want to determine, what am I trying to achieve? What is the goal? And then I want to go in and determine, what tool am I going to use to solve this? Now remember, there's more than one tool. The whole costing module can be used as a tool for short-term decision making. It's just that certain tools are more suited for a certain type of question. Your first type of tool is your CVP break-even analysis. So you can easily determine how many units you should sell in order to make a profit. If this decision is within that unit or more than that, then it will make a profit. So it's a profitable short-term decision. You can also go into your normal short-term decision-making methods. So those are normally your special orders, your discontinuation operations, your make or buy decisions, and then lastly your capacity constraints or your CALF decisions, right? Then you can also do a normal cash flow, NPV analysis, internal rate of return, and discounted cash flow. These will normally be for more longer term decisions, because in the longer term, your fixed costs become more relevant, your financing becomes relevant, and your time value of money becomes relevant. In the short term, you won't need to do a discounted cash flow because you won't have more than 1 year, right? So, but it's still a tool for decision making. Then you can also use your ABC costing, your activity-based costing, in order to get to a cost which you allocated, and then if anything is above that, if your price that you're selling it at is above that, then you are making a profit. And then lastly, you can also use transfer pricing, right? Transfer pricing is a short-term decision. It's how much you're going to sell to your other division in the short term. So it's still a short-term decision-making principle, and you can use that as a tool as well. Right, so if we then step back a bit and think what our approach would be before we jump into a question, I would firstly ask myself these 7 questions, and then that would guide me into answering the question. So firstly, am I making a decision? Be very specific on this. Are you making a decision in this question? If the decision has already been made, then the costs are already incurred. Then you don't use relevant costing anymore. So you need to be still in the process of making the decision. Then is it long-term or short-term? Now remember, a question can guide you to long-term, but it's still a short-term question. Just remember that it's all about the timing of this contract. If the cost in this specific contract period is in the short term, then it's a short-term project. The contract can stretch over 5 years, but if you can renew it every year, your costs are only relevant for 1 year, so it can be a short-term project. Then what is your goal? What are you trying to achieve? And answer that question very specifically. What is your goal? What tool will be best suited to reach that goal? So remember, I gave you a list of tools. You can have extra tools on that, extra things, methods that you studied, but what type of tool will be best suited for this goal and for these 3 answers that you gave in the previous 3 questions? Then I would go and determine what are the relevant costs. So I would go into each and every cost in the question paper and mark it as relevant or not. So I would normally use a highlighter. Let's say you use a pink highlighter and you highlight this cost is relevant, this cost is relevant. And then when you go into answering the question, you can then only go to all the stuff that you highlighted in pink, because you know that will then be a relevant cost. Right, then I would go in and ask, what are the opportunity costs? Are you forfeiting anything in this question or in this scenario? So remember, it's not always clear that you are forfeiting something. You might have to go really read in deep and see that there's certain items that you are forfeiting, certain sales, future opportunities that you are forfeiting because of this, capacity constraints that would result in you forfeiting other sales or other types of opportunities. So you really have to go into that. The first thing that I will always do, just to make sure that I answer this, is I would look at my capacity. As soon as you have a capacity constraint in any question, it links to opportunity costs. Because if you want to go through with this order and fulfill it, you'll have to give up something else along the way. So that's already one link to an opportunity cost. And then my last question that I'll always try and answer is, did I answer the final question? Remember, they're asking you for either a price, a number of units. So you have to give a conclusion answer on, did I answer this question? Yes, you should go on with this project. This is the price that you should ask. This is the number of units you should sell. If we look at the ITC question paper, remember I'm looking at ITC of Jan 2018, paper 1, question 2. Okay, so I'm looking at Izinkuni. If you go and read the question, they have two divisions. They have a pulp division and a paper division. The pulp division makes the pulp, the paper division sells the paper from using the pulp. So automatically we see there's this transfer pricing in between these two divisions, because the paper division would use the pulp from the first division, right? Just note, transfer pricing is a separate video, so you just have to go click on the link below for that. Right, so at the moment they're saying we're selling 516,000 tons at 3,900 Rand per ton. And then they give you a cost breakdown for this paper division that you're working with. Okay, now we're going to do question 2A, which only focuses on the paper division. Very important to note is that in this question at the moment, we are not using any recycled paper. So the special order decision is for recycled paper, or for a portion of the paper to be made from recycled paper. So everything that they give you here at the moment is before the special order has been taken into consideration. Right, so the question that we're looking at is we want to calculate with supporting reasons the minimum price that the paper division should charge for the special order in the financial year 2019. Right, so we're looking at only the paper division. It's the special order. That's where our short-term decision making comes in, and we are calculating the minimum price. Now, don't get confused between minimum price here and minimum price for transfer pricing. This is still the minimum price, selling price that they should ask for the special order. It's not a transfer pricing question. It's still a short-term decision-making question. Very important to note that they told you to assume that the paper division will only purchase the wood pulp from the external supplier. So we're not using this pulp division for our pulp. We are using the external supplier, which we have a price for. So there's no transfer pricing in this question. In question 2A, we are only looking at the paper division buying from an external party. Right, so if we just go look a bit deeper into actually the special order, so it's a new potential customer, it's Bongo, and they've been quoting you for 75,000 tons of paper. The terms are that you have to have 30% recycled paper in this. It commences on 1 July 2018, and there's a fixed price for the first year, whereafter it's renegotiated. So this is where that long-term, short-term decision comes in. It is a long-term contract. It's not just a 6-month contract, but you renegotiate every year. So everything can change after a year. But for that year, your fixed cost will be fixed. You can't change that, and that's where the short-term nature of this comes in. For that first year of the contract, it is a short-term decision. And then you require wood pulp for this question of 105,000 tons. Now remember, you are quoting on paper, which is 75,000 tons, and you require pulp to make that. Important, this pulp will be used to make 75,000 tons of paper. Don't get confused between the two unit measures there. This is your output, your unit product that you are making, and this is the input that you use for your product. Right, so the cost implications, this is all given in the question. So this is where I would start taking my highlighter and thinking what of this would be relevant and what won't. So wood pulp, that is a variable cost, so that'll definitely be a a relevant cost for this question. And in this case, you'll be using the external discounted price. Right, why would you be using a more expensive price if you have a discounted price? You'll be using the external price, which is discounted. Then recycled paper, that is a variable cost, so that'll definitely be a relevant cost for this question. And then your other variable costs, water, chemical, and your variable portion of your overheads. Right. Then you have other costs, so you're buying new machinery. If you didn't have this decision, you wouldn't have to buy that new machinery, so that's definitely a relevant cost. But very important, what cost of that would be relevant? Is it the whole cost of the machinery, or is it the depreciation over the year? And in this case, you'll only be using the depreciation for 1 year. Right, remember this is only a 1-year contract, so it's 1 year depreciation that is relevant for this question. And then if you do not accept the order, you would have been able to reduce your fixed cost by 25 million. That is what we call an opportunity cost. It's a cost saving that we are now forfeiting because of this decision. Right, so it's a forfeited cost, so it'll definitely also be relevant. And then they'll also tell you in the question, you want to have a margin of at least 25%. That is definitely relevant for this question. Remember to include that margin because your goal of your question is to calculate a price, and that price would have then been cost plus the markup. Right, so if we go back to our approach that we wanted to follow, we are answering all 7 of these questions before we start with this question. So firstly, am I making a decision? Definitely yes. I want to know what should the minimum price be. Is this long-term or short-term? Now remember, in the ICC question, they actually worded it as the long-term special order. That was the wording that they used. But in this case, it's definitely a short-term question, right? Because we're only looking at 1 year. Thereafter, we are renegotiating and the short-term nature is lost. We're only looking at how many should we sell for this first year for which the price is fixed. Then what is the goal? We want a price, right? A price for this whole project. Now remember, you can calculate this as a price per unit, or you can calculate it as a price for the whole project. In this case, what would be easier is to just calculate a price for the project as a whole, not calculating it per unit. That might get a bit messy, but if the question asks you to calculate it per unit, you would just divide it by the 75,000 tons that you would want to sell. Then what tool will be best suited for this? This is your normal special order decision, but I'm not going to focus on how to lay out a special order. I'm going to focus on my 2 principles, relevant costing, opportunity cost, adding that together to get to a cost plus a markup. Right. What are the relevant costs? So we already did that. We identified which costs are relevant, and we do have opportunity cost, which is the savings that we are missing out on. Okay, and then the last question we'll get back to right at the end. Right, so if we jump into answering the question, firstly I'm making just a column to put in all my rand figures just to make it a bit easier for exam technique wise. Then I'll first put in all my normal variable costs that didn't change drastically, so it's just your normal variable costs. It would have been your water, your chemicals, and your variable portion of your overheads, which is 250 per unit, 450 per unit, and 225 per unit, which gives you 95 per unit. We multiplied with the 75,000 tons that we are selling, and that then gives us a cost of 69,375. Okay, I'm doing this in rand per millions. They gave you most of the numbers in millions, so let's just use that going on. Right. Then other inputs that might change because of the decision. Firstly, it's the wood pulp. Right, so we are using 105,000 tons of wood pulp for this specific question, and we are using the discount price because why won't you use a discount price? If you've got a discount, use it, and that gives us a cost of 525,000. Then we also have our recycled paper, which is new for this question. And we are going to include 45,000 tons of recycled paper, and they tell us that that costs us 500 rand per ton, so we can include that at 22,500. Then we have our machine, which we said is definitely a relevant cost, but we're only including it at its depreciation. Just note that they gave you a residual value of 7.5 million, and then we are dividing that by the 5 years for which the machinery can be used, which gives us a depreciation of 13,500. We also have our opportunity costs. Remember, we said we should not forget our opportunity cost, which we're including the 25,000, or well 25 million in this case, that we would be losing out on, the forfeit. And then, very important, there's an increase in our repairs and maintenance fixed overhead. Now, in this question, they told you that the repairs and maintenance increase by this amount whenever there's a new order or more units sold. So they gave you a table. I would recommend you go back to this question. We would normally call this a high-low or a step fixed cost. So this is very important exam technique to practice on that cost. So we're going to look at that table. So they gave you a table showing 100,000 units, 200,000, 300 and 400. And then they told you the cost at each of these units would be 13, 15,500, 18, and 27. Now they told you that at a specific point, these costs increased. Why did they increase? Because your capacity level increases, and if you go over a certain capacity level, there's certain fixed costs that will increase with that. Now if we look at this, the fixed cost here would have been 2.5, 2.5, and then here it increases to 9,000. So we can see after 300,000, after we have a 300,000 level of units, our fixed cost increase. And definitely if we look at our current capacity and this extra 75,000 tons, we would definitely be over this range, right? Now remember, our variable costs we already included in the question. They gave that to us, that's already included, we're not looking at that. What we are bothered with in this question is that increase in fixed cost. If we didn't have this special order, we wouldn't have had that increase in fixed cost, right? So the fixed cost changed because of the decision, so it's a relevant cost. Right, so if we look at these fixed costs, we can see that over here, the cost increased by 6.5 million. Right, so that increase is the fixed cost increase that we deem relevant for this question. And we would then include that increase in our fixed costs into our question. So this would come in here, 6.5 million is our relevant increase in that fixed cost. Right, so this gives us our answer. So in this case, I'm not going to calculate that at the moment. Whatever you have done here would have given you a principal mark for this answer. And then I would add the 25% markup to this question. Now remember, on that 25%, I want to add a cost plus markup. So I would be using my ratio of, I have 100 and I want 125 to get to my selling price, which is then my final answer. So below this, I would have a sentence saying the selling price should be this amount that I've calculated over here. Right guys, thank you so much for watching this video. If you have any questions on any of the content that I've uploaded or any of the other RTC questions that is going on below this, please just leave a comment in the comment box below. I'll make sure to get to it as soon as possible. Just remember, the videos will start flowing in as I get more time to do them. So just keep a heads up or eye out on my Facebook page and on the YouTube channel for any new content updates. Just remember, subscribe to the channel below so that you can have all the content updates as they happen to make sure that you are RTC ready if you're prepping for RTC, or if you have any other questions, make sure you keep an eye out on the channel for when I answer that question. Thank you so much for watching.